Hello everybody and welcome to another financial analysis video, and today we are going to be looking at Vodafone. So my name is Ted Wainman and we are going to be looking at reading and interpreting the financial statements of Vodafone, see what it tells us about the business, how it has been performing, and then we will be reflecting on its current share price. Now, for those of you who don't know, Vodafone is a major telecoms communication provider. So it's based with me here in United Kingdom, just down the road actually from London, and predominantly works in Asia, Africa, Europe, and Oceania. It is a very, very large telecoms provider. And we are going to be looking at their financial results to see how they have been performing. Now, don't forget, please do like, share, subscribe to the channel, and also let me know your thoughts. So if you've got any insight on Vodafone, any ideas, if you like what you're hearing, then please do let me know. If you disagree, more than happy to disagree. Obviously do that politely in the comments box, and don't forget to share this with your friends and colleagues. We are doing Vodafone at the request. So this is Eric Nicoletti, who asked for it. It says 4 minutes ago. It's not actually 4 minutes ago, but he did ask for his views on Vodafone PLC, and he also mentions capital gain versus dividends. So this is for you, Eric. And if you would like to recommend a company for us to look at, we do get a lot of requests. So I apologize that we can't do every single company, because otherwise I'd never get any sleep. But we will try and look at the companies. If you can give me a little bit of reason as to why you're looking at it, why you're interested in it, a little bit of background rather than just throwing names at me, it makes it a little bit more interesting. A little bit of background to the request is always good. Anyway, without further ado, let's get stuck in and have a look at Vodafone's financials. So here is Vodafone's annual report for 2021. Now, we're recording this in January 21, in the 12th of January. So I'd be very impressed if they could get their annual report out that quickly, so in 2022. So this is not going to be for the year end December. Their year end will be during earlier on in 2021. So if we just go to the income statement, we'll find it. Here it is. So here's the income statement, and we can see it's for the year ended 31st of March 2021. So this is about 9 months out of date, and we will be looking at their first half results as well a little bit later on. So this is the annual report. This is the audited accounts, formalized set of figures, and we will look at the trading update and to see if it gives us any insight. So here we go. Let's start off with the income statement, and we see on the income statement, top line as ever, revenue. So there's the revenue. We're in euros. We're in millions of euros. So about 44 billion euros. That's 1,000 million euros, down from the previous year of nearly 45 billion. So that's about a 3% drop. The cost of sales, well, mainly very high cost of sales, but that's really going to be their network and the kind of the running the business. Now, often when you look at network operators such as Vodafone, you'll often see that the cost of sales is missed out, and they just stick the cost of sales in under their kind of admin expenses as the cost of running the business. So that'll be really the network costs. They've got some S&G and A. So this is the sort of sales, general, and administrative, and then they've got a whole lot of other costs down here as well. And I'm not going to go through all of them, but I will just highlight this one here, impairment loss. Okay, now an impairment loss is when you buy an asset and you no longer need it. So for example, if you buy a computer and you're going to be using it for 3 years or 4 years, and then suddenly you drop it in the bath by mistake and it becomes useless, you have to impair it. Effectively, you're writing it off. Now, nothing in this year, which is obviously good. However, if you look at previous years, some fairly big numbers coming through there. And unfortunately, Vodafone has a tendency, so they have a history of this. I mean, all the way back to kind of 1999 when they bought management right at the very top of the TMT bubble. For those of you who are of a certain age will remember that. Vodafone has been, they've been buying businesses, and they have a tendency, as far as I can see, to overpay for those businesses. And then they have to impair them, they have to write them down, and they're taking those through as losses. So if you look, for example, back in in the year 2000 or 2006, I think it was, 2006 accounts, it's, that they're generating 18 billion in cash, but they're losing 22 billion because of massive write-downs on their investments. So quite nice to see that that's gone to zero. Question is it going to stay at zero? Have Vodafone actually learned their lesson and stop overpaying for business acquisitions? If history is anything to go by, then no, they haven't, but who knows? So what else have we got a little bit further down? So operating profit, so they're making a nice little profit, 5 billion, up on the previous year, but again, the reason that it's up is the revenue's down, but the profit is up because they no longer have this impairment coming through. And also we notice finance costs seem to have come right down. I mean, that's a significant fall. We'd expect to see either a big fall in the amount of debt, or they're managing to actually finance the business much cheaper. Also quite interesting, and doesn't really kind of make sense, that if we look at the profit before tax and the tax, they're paying out in effect pretty much all of their profit in tax. That's an effective rate of about 88%, and something doesn't quite make sense there. I'm not sure exactly what it is. I'm not a tax accountant, and I'm sure the tax accountants in Vodafone will be able to give you a little bit more of an explanation about that, but it does seem slightly bizarre. I would have expected, traditionally you make a 4.4 billion profit, you're going to pay out about 20 to 30% in tax, and therefore they should have been sitting on a nice healthy profit of about 3 billion. But unfortunately, it's only down to $500 million, so pretty small. But we'd expect that maybe that's got some kind of one-off or prior year adjustments in there. And if they can maintain this performance, then hopefully they'll start to see some fairly significant numbers. We'll have a look, as I said, at their H1 for 2021 in a minute. Before we do that, though, let's go and have a look at their financial position. So this is the balance sheet. On the balance sheet, lots and lots of fixed assets, or non-current assets, we call them. This is the investment capital in the business. Lots of property, plant and equipment. Okay, so this is all of the network. So these guys, sorry, I've just highlighted the wrong one. My mistake. So lots of property, plant and equipment, 41 billion. So this is all the stuff they need to run the business. This will be the switches and the masts and the kind of the cables and all the other bits and pieces and things you need to run a network. You also need licenses in order to run a network. You're going to need your 3G and your 4G and now your 5G licenses. You buy those from the government, and that's going to be mainly their intangible, going to make up a substantial amount of those intangible assets. So these are licenses, intangible assets, things we own which we cannot touch. And then also lots of goodwill, 32 billion of goodwill. You'll notice that goodwill has stayed the same. That's good because A, they didn't buy any businesses, and B, they haven't done any impairments. They haven't written any of it down. So there's your goodwill, and the goodwill arises on acquisition, and this basically tells me that Vodafone has expanded by buying other companies, and that's absolutely fine, because if you're a network operator, to set up a network in a new business, in a new territory, very, very expensive, very time consuming and quite hard work. You've got to build the network, and then you've got to persuade everybody to come onto your network. A lot easier just to buy the incumbent. So what you tend to see from telcos is that they go into a territory, and if they want to expand, they just buy the incumbent in there. But as I said, sometimes Vodafone seems to have had appears to have had a tendency to overpay for those acquisitions. Deferred tax asset. This is a tax refund that they're going to get at some point in the future. It's a pretty big number, 21 billion. But if you want to see more about that, you can go and have a look at note number 6. So there we go, 27 billion euros of assets, a little bit down from the previous year of 135. The current assets is all of these numbers here. So this is about 27, 28 and a bit. So you'll see that they've got some assets held. So these are things which they're trying to turn into cash, and they're typically going to have some cash. And they've got quite a lot of cash, 5.8 billion, a little bit down from 13.5 billion. But they've got enough cash. They've got some other investments that they can sell, so that'll be just another form of cash. These two numbers you can really almost read as cash together. Some trade and other receivables that owed some money, not a lot, because what you tend to find with telcos, again, this is another part of their business model, is that there's lots of prepaid SIM cards. So lots of their customers will buy the SIM card and then use the service, so there's no trade receivables. So this will tend to be your corporate customers and your monthly, your kind of people on a contract, and they like contract because it's sticky, they stay around, and they'll be with them for the foreseeable future. But they also like the prepaid SIM because it gives them cash up front. So a little bit of a mix of that is obviously quite healthy for these guys. Scrolling down to the liability side. Now, we can't get this onto this. I probably can if I just shrink my page a little bit. So here we can see, here's the current assets we were just looking at, which is about 28.27 billion. And we compare that to the current liabilities, which is 28.711 billion. So the current liability is very slightly larger than the current assets. Now, traditionally, that would be a bit of an alarm bell, but what we tend to find in the telco world is that actually they can operate with negative working capital. They can operate with accounts payable as much as their current liabilities as higher than their current assets. And the reason for that, again, is because of this business model, this cash flow. They tend to get the cash coming in from their customers. Either they are on a prepay and they are buying their SIMs, or they're on a post-pay, which they're paying, and the bills are sort of, on direct debit, and they're clearing pretty quickly. And of course, if you don't pay your bill, your mobile phone gets turned off, and most people can't survive without their mobile phone. So this is pretty sticky, pretty strong cash flow here. So from a liquidity point of view, we may, in a traditional company, I may go, oh, that looks a little bit bad. But for a telco, absolutely not a problem. In fact, it looks pretty high for a telco. We tend to see much lower than that. I think the industry average is somewhere around 0.6 or something like that. So looking at the other liabilities, what have we got? Looking at the current liabilities down the bottom, very big trade payables. Okay, this is actually quite a big number, certainly compared with their cost of sales, and suggests that Vodafone is not very good at paying its bills. And again, that's good for its cash flow. So it's a big company, big organization. It's got a lot of financial power, and it's using that power in terms of payment terms. So if you are supplying to these guys, don't expect or expect a sort of hard negotiation in the payment terms. Don't expect to be getting paid within 30 days. Also, they've got some short-term borrowings compared to the long-term borrowings. Don't forget that, again, those short-term borrowings, they're probably going to refinance those numbers. So they're not going to use the current assets to pay those amounts. So again, when we do our liquidity ratio, we can probably ignore those elements, and we can double check when we get to the cash flow to see whether they really are doing that. But total debt has come down. I mean, not excessively. You remember we looked at the finance costs. Finance costs have dropped from about 3.5 billion to just over 1 billion. So the debt hasn't come down that much, but obviously they've been refinancing. They've been getting their debt under control. They've been reducing that debt, and obviously that when they are refinancing, they have been managing to refinance on much lower rates, and that kind of makes sense. These guys will be borrowing for reasonably long period of time. They'll use the bonds. They may find that those bonds are running at sort of 5% coupons, for example. And in today's environment, as they are able to kind of refinance, they're able to get much cheaper rates in a lower interest rate world. Nothing else really jumping out at us in terms of the numbers. Quite interesting, this one, trade and other payables. They've got some more trade and other payables due, which are kind of non-current, i.e. due more than a year away. And so that leads us on to the equity. So equity, pretty healthy equity, but quite interesting that they got 58 billion of equity. But look at this, all of it is down to investment by the shareholders. So there's about 155 billion of investment, and they're sitting on retained losses of 123 billion. Now, this is again quite interesting and not something that kind of, you don't often see this because they are paying out dividends, and traditionally you pay out dividends out of retained profits. Now, this isn't a problem for these guys. It's just saying, look, they've had a massive amount of investment. They have made some losses, but now they've kind of settled down. They're generating profits. They've got strong cash flow. The guys who kind of, put the money in earlier on, they have lost a lot of that, and the company is now kind of making profits, and it can afford to pay those dividends, which we will see in a minute. In fact, we'll have a look at those now. So we'll look at the movement in equity, and we can see in the movement in equity that they are paying dividends. Let me just move it down to here so we can see in the previous year. We're looking at this column here. So previous year, dividends 2.3 billion. In this year, dividends 2.4 billion. Doesn't look like there are any or no substantial share buybacks going on, so none of that kind of treasury shares that we often see for some businesses. We'll just scroll back up. We can see the column headings. So treasury shares is in this column here. There's not a lot of action going on in there. So that's they're really distributing a wealth through the payment of a dividend, and they're trying to keep a nice a sustained dividend. You'll notice that it was a lot higher in 2018. It has dropped since then, and they're trying to keep that 2 billion a consistent 2.3, 2.4 billion. Last one is the cash flow statement. Now, when we look at cash flow statements, if you look at a lot of the other videos we've been looking at, you'll remember that the cash flow statement, the first part of the cash flow statement takes the profit, turns it into a cash profit effectively. These guys, they just give you the cash profit. There it is, 17 billion. And note 18 gives us the reconciliation. We'll have a look at note 18 in a minute. But what we see here is that looking across these guys, they're generating a lot of cash. I mean, really a lot of cash. We were talking about profitability of what kind of 5 billion on an operating basis, but these guys are 17 billion, 17 billion, 13 billion. So a very, very consistent story in terms of its ability to generate cash. A lot of that problem in terms of the profitability comes down to the fact that a lot of that cash has to be invested in assets, and also they have a tendency to buy companies and pay too much for them. So let's have a quick whiz down to note 18 to see that reconciliation. So here is note 18, and we can see at the top of the screen there's the profit figure. So that's kind of the profit from continued operations, and there's that kind of the operating profit of about 5 billion. You remember that we saw that on the that's come straight out of the income statement. And there is the cash generated by operations, and actually the kind of the total cash, the figure that we were looking at the top of the cash flow. Biggest number, very, very by far and away, is depreciation and amortization. So basically these guys, they have lots and lots of assets. They've got lots of capital. They've got phone masts, switches and all of that is depreciating, and that is a big cost to the business. Now, what you often find is that a telco such as this will actually state that on its income statement. So quite interesting that Vodafone chooses not to, but lots of companies will. They'll actually state that on the face of the income statement to really just highlight to the investors and say, look, a big chunk of our costs are things we can't do anything about it. It's all the stuff we need to run the business, and we're depreciating it, and the depreciation rate has been set by the directors and can't really be changed. So long and short of it is these guys are generating lots and lots of cash, which is good. So back to our income statement again. Here we go. So inflows from cash, the cash inflow from operating activity, 17 billion. They are then investing. So the next section is all about the investing, 9.3 billion euros being invested. What are they buying? They're buying intangible assets. So these will be licenses and mainly licenses for these guys. Property, plant and equipment. So they are buying lots of property, plant, equipment. And this purchase of investments, this is just parking spare cash. So don't get to, the disposal of investments. These two numbers or these two lines really kind of probably need to be actually just taken out of the whole thing, because that's just kind of putting money on deposit and taking it back off deposit. It's not really investing in the future of the business. So we're much more interested in these two lines, which is the purchase of property, plant and equipment, and the disposal a little bit down here these lines are the disposal of property, plant and equipment. You can see that, you know, on a net basis, they are investing. However, quite interesting, the depreciation charge, you remember, was about 14 billion. These guys are only spending, what's that, about $8 or $9 billion. So, you know, they're not investing at the rate they are depreciating. Now, that could be an alarm bell. That could say, you know, are they not really investing at the speed that the existing assets are depreciating, which means that they, you know, the business is effectively contracting. So there's a kind of just a little bit of an alarm bell there, a little sort of warning shot, especially as it's fairly consistent year on year. Last section is all about the financing. Here we see this is kind of, if these two numbers are matched, the company is refinancing its debt. So we can see the top line is the proceeds from the issue of long-term borrowings, going to the bank manager and borrowing money. All these guys, they'll raise it on the debt capital markets through the issue of bonds and the repayment of borrowing. So we can see that substantially, you know, they did their debt has come down substantially in 2021. It also reduced in 2020, but it was increased, for example, in 2019 in the right-hand column. We can also see the dividends being paid out. So there's a sort of re-emphasize the fact that these guys are paying out dividends. They're paying out interest on the debt. The debt interest is fairly similar year on year. Those are the kind of the main movements. So summary is that they got net cash outflow is 15 billion from their financing activities. And so overall, for Vodafone, they see a net cash outflow during the year of 7 billion, which means that they started with about 13 billion in the bank and they finished with about 5.8 billion in the bank. And the reason for that fall is this number here, which is a sum total of the numbers that we've been looking at before. Okay, not a big issue. Doesn't, you know, there's no real cause for concern. They basically said, look, we've got some spare cash. We're going to use some of that cash in order to pay down our debt. There's no point just sitting on cash unless we've got something really good to do with it, either to invest or to go out and buy another business, for example. And that's absolutely fine. So they're paying down their debt, and that makes it a little bit less expensive in terms of interest payments, and also means that the balance sheet is a little bit stronger, a little bit strengthened. So if we look at their debt, and I've run some numbers here, their debt is, 67 billion of debt. And the equity, if you ignore the retained losses, the equity is up to 179 billion. But even with the retained losses, the equity is 57 billion. So they're about kind of, a little bit, 55% debt funded versus equity, for example. So there is the results of Vodafone. Now let's do a quick little update and see how they've been performing since then. So here is the 6 months. Ended 30th of September 2021. So this is about 3 months old, 3 or 4 months old. And just for the 3 months, we can see the profit for the financial period is, well, it's 122,177. Interestingly enough, the profit for the previous period was 1468. That would have been included in the numbers that we were looking at. They'd have made this loss. I can't see any write down, which is good. So just sort of looking around here, and I can't see any impairment. So hopefully that means that it'd be really nice if Vodafone could just stop impairing its assets and say, right, we've written them down. Because as I said, as far as I can see, it's been pretty much impairment of assets every single year since 2006, and it's driven a lot of those losses. They spent a lot of money on management, put it like that. So otherwise, it's looking all right. It's not brilliant, but it's looking okay. I mean, it's still pretty low margin business. There are telcos operating on net margins of 20%, for example. These guys, their net margin is about 1%. So it's really small. This is about 5% for the first half. Balance sheet won't have changed very much. It'd still be the same big numbers in the same positions. Nothing really jumping out at us there that's kind of a major shift from the numbers we were looking at. And again, if we look at the cash flow, very strong cash flow. So 6 billion of cash flow. You double that, you're up to about what's 13 billion, which is a bit lower than the 17 billion they had this year. But they've got the cash flow. They are investing, and they are, they're continuing to pay down their debt. And a little bit of repurchase of Treasury shares. So this 1101, this number here, this is effectively they are buying back their own stock. So another way of distributing shares, so distributing profit back to the shareholders. These numbers here, you'll notice they're a half because they'll pay an interim dividend and then they will pay a final dividend. So again, looks like they're maintaining the dividend, and they should be able to maintain that for the foreseeable future. So there we go with half two, a kind of sort of very quick update. So let's see what that tells us in terms of the share price. Quite interesting here. I haven't got a P ratio. I'm not sure why I don't have a P ratio, because these guys, they are now making a profit. So it's a little bit strange that we haven't got a P ratio, but there you go. Anyway, if you take the kind of, the 536 million of 2021, they're at about 60 times earnings. That looks quite expensive to me, but I think the kind of underlying profitability is much higher than that. So I think that, actually this is, not a massively expensive business. And also what's really interesting, that 31 billion or $32 billion of market capitalization. I mean, the equity in the balance sheet is valued at about 57 billion. So effectively, that's saying that you are buying this company at a discount. It's trading at about a 45% discount to the net asset value. So it looks cheap. Now, looking at that share price, you can see it's been quite a rocky ride. The dot-com boom, the TMT stocks of 2000, it jumps out at you when everything just got majorly overvalued, and that's when Vodafone was buying lots of other companies, getting very, very punchy, and then found out that it was paying too much of them. And it's really had a pretty lackluster ride since 2003, and it's kind of bounced up a bit and then bounced down a bit. And if you've been a shareholder, you'll probably be feeling a little bit exasperated. But you kind of look at this and you think, I mean, it can't get that much cheaper. This looks to me like, potentially it's a value. It's a value stock. It's got a great dividend yield. Look at that dividend yield of 6.44%. That's got to be worth an investment. It doesn't look like it's going to go much. The share price can go much lower. And if it does go much lower, then you're just going to get a better yield on your investment for the dividend. So you're buying a pretty strong dividend. You're buying something which has got a lot of cash, a lot of good cash flow. The telcos, they're not going to go anywhere. It's got to keep investing. Maybe this is part of a well diversified portfolio. Who knows? So there we are. Vodafone, is it a buy? I don't know. It certainly doesn't look expensive. It looks, like it might be reasonable value for a value investor. You can look at the share price. If you're a momentum investor, if you're a growth stock, then it's probably not for you, but I hope you found that financial analysis useful. And once again, please don't forget to like, share, and subscribe to the channel. And let me know any comments, any insight you have on Vodafone, and also to recommend any companies you would like me to have a look at. So thank you very much indeed, and I will see you on the next video.